Rocket Lab has doubled in the last 5 months, going from $3.50 to over $7 a share. And the company crushed its 2Q24 expectations, and it's positioning itself as the alternative to SpaceX. So, is Rocket Lab on its way to the moon, or is it headed for a crash landing? Let's dive in and find out. All right, 3 points that we are going to cover in this video. Number 1, background/business model. Known for their Electron rocket, a small launch vehicle designed for delivering payloads to orbit, this company, Rocket Lab, is the fastest commercial company to 50 launches in orbit ever. Part 2, the opportunity, positives and negatives. So in a future where space travel becomes commonplace, Rocket Lab, like SpaceX, wants to be considered a household name. So is this stock ready for launch, or does it need to be grounded? And how is it different from SpaceX? I've gone through the recent 2Q24 results and have analyzed the important insights just for you. Part 3, valuation. On Wall Street, we build 3-statement financial models culminating in a discounted cash flow, or DCF, valuation. I have built a 3-statement model with a DCF for Rocket Lab, and I can't wait to give you all the details. So let's dive right in. If you're enjoying this, please smash that like button. All right, part 1, background/business model, company background. Imagine a world where space isn't just for governments and billionaires, but it's accessible for businesses of all sizes. Enter Rocket Lab, a company that wants to democratize space. But how did they get here? So it's founded in 2006 by Peter Beck. Rocket Lab is a leading aerospace company specializing in launch services, spacecraft production, and space systems. Now, if you're wondering, Peter Beck became Sir Peter Beck in June 2024 as part of the King's birthday honors in New Zealand.
Call me Sir, goddammit!
Known for their Electron rocket, a small launch vehicle designed for delivering payloads to orbit, they're currently developing the Neutron launch vehicle for large spacecraft and constellation deployment. They also design and manufacture various satellite platforms. From its first orbital launch in January 2018 to date, Rocket Lab's Electron launch vehicle has become the second most frequently launched U.S. rocket annually and has delivered 191 satellites to orbit for private and public sector organizations. Now, the company is headquartered in Long Beach, California. If you're like me, like Sublime. The company went through a SPAC, or a special purpose acquisition company, merger in 2021, trading under ticker RKLB on the NASDAQ. Rocket Lab's Photon spacecraft platform has been selected by NASA to support missions to the Moon and Mars, as well as being the first private commercial mission to Venus. Rocket Lab has 3 launch pads at 2 launch sites, including 2 launch pads at a private orbital launch site located in New Zealand and a 3rd launch site in Virginia, USA. Company mission: provide end-to-end space solutions, including satellite design, development, launch, and on-orbit management. So business model, how do they make money? We all know launching rockets sounds expensive, but how exactly does Rocket Lab make money, and why do companies around the world trust them with payloads worth millions of dollars? So let's dive in here. Space Systems is 70% of revenue. That consists of spacecraft engineering and design services, components, manufacturing, and on-orbit mission operations. So they're producing spacecraft components such as solar panels, reaction wheels, and satellite avionics. An example would be satellite constellation support, where they're developing and launching satellites for constellation programs that require frequent and reliable access to space. Second part of their business, launch services, which is 30% of revenue, which comes from launching satellites into orbit with the Electron rocket. So they provide launch and launch-related services to customers on a dedicated mission or rideshare basis. So another example would be the Photon spacecraft platform, which provides an end-to-end service from building and launching satellites to in-space operations, catering to both government and commercial clients. So what about the 2Q24 results? The space industry has its ups and downs, and Rocket Lab's no exception. So how did they perform in the latest quarter? Let's look at the numbers to find out if they're really reaching for the stars or facing turbulence. All right, revenue. So they reported $106 million in revenue, a 71% year-over-year increase. That's the highest revenue quarter in company history. It demonstrates the strong and growing demand for launch services and space systems products, and importantly, the team's ability to execute against it. Now, they have a backlog of $1.067 billion as of 2Q24. So Rocket Lab collects the majority of cash long before liftoff, but they only recognize the revenue at launch. At contract signing, 10% of the total contract is paid. 9 months out, 20% is paid. The docks are delivered. 6 months out, 30% is paid. They do a spacecraft fit check. 3 months out, 30% is paid. They go through a mission readiness review. And then at launch, liftoff, the final 10%. Gross profit was $27.2 million for the quarter, showing improvements in cost efficiency as launch cadence increases. Launch activity, I mentioned earlier, they successfully launched the 50th Electron mission. So they reached 50 launches faster than any commercially developed rocket in history. Their cash position is amazing with around 500 million in cash and cash equivalents and marketable securities, which provides a solid runway for continued innovation and expansion. Now, it's very important to understand the company still has negative EBITDA, operating income, net income, and cash flows. So it's a very early stage, high growth company. It's only covered by 11 analysts on Wall Street, so there's not a lot of groupthink, and there's more opportunity with a small stock like this than larger covered names. All right, part two, the opportunity, positives and negatives. I like to hear the bad news first. Let's get into it. It's not all smooth sailing for Rocket Lab. What are the risks? Is the stock too volatile to consider right now? So, profitability concerns, this is a big one. Despite revenue growth, Rocket Lab is not yet profitable, and future profitability is dependent on scaling launch and space systems operations. Competitive pressure. Companies like SpaceX and other emerging small launch providers are tough competitors, potentially squeezing Rocket Lab's margins. High capital expenditure. I mean, we're talking about frickin' rockets here, right? So, developing rockets and space systems is very capital intensive. And while the company has a healthy cash balance, future funding needs may dilute existing shareholders. Macroeconomic risks. So, economic uncertainty may reduce the availability of capital for growth and increasing borrowing costs. Stock volatility. So, the stock has been highly volatile, reflecting risk appetite of investors in the space sector, but it's something to be aware of. All right, positives. So, why should investors consider Rocket Lab right now? What makes them stand out in the crowded and competitive space sector? Here's why some think it's a buy. Proven track record. So, Rocket Lab's Electron rocket is the fastest to 50 launches in commercial history, establishing itself as a reliable player in the small launch market. Diversified revenue streams. So, beyond launch services, their space systems and Photon platform provide recurring high margin business opportunities. Growing market. So the small satellite and space systems markets are projected to grow significantly. Rocket Lab is well positioned to capitalize. Vertical integration. So they have control over manufacturing, launching, and space operations, which gives them the competitive edge in both cost control and scalability. Partnerships and contracts. So they have strong relationships with NASA as well as DARPA, which is Defense Advanced Research Projects Agency, and commercial players that shows high confidence in Rocket Lab's capabilities. So I know the question you're thinking of, how is Rocket Lab different from SpaceX? So I'm not exactly sure when the MMA fight between Zuck and Elon's supposed to happen, but Musk may have a cage match with Sir Peter Beck in the commercial space sector, so he better practice his figure four leg lock. All right, here's the tail of the tape. So number one, small satellite focus. Rocket Lab specializes in launching small satellites with its Electron rocket. SpaceX focuses on larger payloads with the Falcon 9, often combining smaller satellites in ride shares. Number two, quick and flexible launches. So Rocket Lab offers frequent, dedicated small launches, making it easier for customers needing quick access to space. SpaceX's larger rockets have less frequent launches, especially for small payloads. End-to-end service. So Rocket Lab offers satellite building, launching, and operations through its Photon platform, providing full service, whereas SpaceX primarily focuses on launching, not satellite operations or design. Number four, space systems products. So Rocket Lab produces satellite components like solar panels, offering additional services beyond launches. SpaceX doesn't sell satellite components, it's focused on rockets and Starlink. Also, a geographical advantage. Rocket Lab has launch sites in New Zealand and Virginia, providing flexible scheduling and orbit options. SpaceX launches from major US cities, which can be more crowded and less flexible. So, what's the takeaway? This gives Rocket Lab a nimble, specialized edge in the small satellite market. All right, part three, the moment we've all been waiting for, the valuation. We begin with the balance sheet. So cash has increased 11.2x over the last 3 years. We're going to see this later on in the cash flow statement. Now, just remember, this is one of the most capital-intensive businesses. We see an almost 3x increase in PP&E over the last 3 years, going from $50 to $145 million. Debt has increased substantially from zero in 2020 to $476 million at the end of 23, and then $420 million at the end of 2Q24. Now, pro tip, always look at the 8K filings after they file their quarterly or annual filings, and always search for subsequent event in the filing. Had I not done that, I would have missed the $355 million of convertible debt that they issued in February of 2024. Now, while Rocket Lab is net cash, which means cash is greater than debt by $128 million, that is slated to change in our projections due to the high required cash of the business, combined with the negative cash flow projected into the 5 years of the model. So what's the takeaway? This is a capital-intensive business that's being financed with new debt rather than retained earnings and positive operating cash flow. The increase in leverage is a bit concerning and something to keep an eye on moving forward. Let's hop in the model. All right, so as we mentioned, 11.2x 3-year increase in cash and cash equivalents, which is awesome. Almost tripling of PP&E. Something else to be aware of, debt has increased substantially. I caught the 355 of convertible debt, but also they're going to be taking on a lot of new debt in the future. In the model, $10.2 billion worth. Because they have negative cash flow, they're going to need debt to continue to finance the business. These are the types of things that we really have to be aware of and keep an eye out for. All right, income statement revenues have increased 7x over the last 3 years. Gross profit became positive in 2021. Gross margin has gone from negative 17% in 2020 to 27% positive in 2023. This is an impressive result considering the high cost to launch rockets. Now, high R&D means negative EBITDA. R&D stands for research and development. And while we have negative EBITDA through 5 years of our projections in the model, Wall Street has Rocket Lab becoming EBITDA positive in 2026. Now, net income is also negative, resulting in negative retained earnings moving forward. We're going to see this next in the cash flow statement. So what's the takeaway? It's important to understand that this makes a DCF model very difficult to do for a company at this stage in their life cycle. This is an atypical company for a value investor like yours truly to consider because we need positive cash flow. It's like having a baby in diapers and figuring out what they'll do for their career. They can't even speak yet. So hopefully the positive turn for gross profit will also occur in the near future with EBITDA. Let's hop in the model. All right, income statement 7x increase over the last 3 years in revenues, which is phenomenal, but we do have to talk about the fact that they have negative EBITDA as well as negative net income. This is something that has to change in the future. It doesn't change in the future in our model, which you can obviously see right in front of you, but ultimately they should get to a point where they reach scalability and their revenue growth is able to outpace their costs. All right, next we have the cash flow statement. So negative net income has driven negative operating cash flow. CapEx has more than doubled over the last 3 years. Now, because the company generates negative cash, it has to rely on debt financing on a moving forward basis. Now, this is not sustainable, and it's very important that the company becomes self-sufficient from a financing perspective ASAP. Now, if the trends continue where costs are not reduced as revenue grows and the company becomes more reliant on debt financing, debt will 12.7x by the end of our model. Yikes. Let's hop in the model. All right, cash flow statement. Remember, negative net income is driving negative operating cash flow. Unfortunately, that's just the reality. It's an early stage company. CapEx, we have a doubling of CapEx over the last 3 years. They're obviously investing in rockets and a lot of CapEx intensive stuff. Looking right here, we have negative cash being generated. So they're using rather than creating cash from their business. And then this is where it gets really alarming. The fact that they're going to be creating a significant amount of debt in the future, just something that we have to keep an eye on. Okay, forecast drivers and DCF assumptions. So operating expenditures consisting of COGS, cost of goods sold, R&D, research and development, and SG&A, selling general administrative, has decreased 30% on a relative basis over the last 3 years. This is phenomenal. But it's very difficult to determine if this will continue and when it will level off. So I just kept costs flat to be conservative. We're going to see this next in the DCF valuation. The company has paid $123 million of debt over the last 3 years and is slated to pay another $116 million of debt over the next 5 years. With the $355 million of the convertible that I mentioned coming due in 2029, that has to be considered because it's after the end of our model. Now, they have a beta of 1.4, which is substantial, but we've seen higher with some of our more recent tech valuations. Think of like NVIDIA, Tesla, and Palantir. Now, the company was net cash $128 million at the end of 2023 and is still net cash by $76 million at the end of 2Q24, but that shows us a cash burn rate of $26 million per quarter. So although they're net cash, which means cash is greater than debt, they're burning through it very quickly. So they're going to need more debt or more equity in the future. Now, currently, Rocket Lab's TEV to revenue multiple is 11 times, which is crazy. That's not the terminal multiple that we're going to use, and I'm about to get into that when we hop in the model. So what's the takeaway? Conservative assumptions are going to equal conservative results. Let's hop in the model. All right, super quick shout out here. I'm mentioning that the cost, those OPEX, 231% of revenues back in 2020, and then at this current year, 161%. So there's been a massive reduction of 30% on a relative basis. So something to be mindful of. They are doing well. They're doing better with costs. Debt pay down, pretty substantial. Moving forward, they're going to have to pay a pretty significant amount, well over $100 million. All right, coming down here to DCF assumptions, their pre-tax cost of debt is significantly higher than a lot of the companies we've looked at recently. That's because the cost from their lenders is going to be way higher because of all the uncertainty and the negative cash flows. Now, Considering that they have a decent amount of debt, they actually have a very reasonable WACC because debt reduces the total cost of capital. So 8.7% is actually not that bad. Now, cash and cash equivalents, almost $500 million. Again, a big part of that is the $355 million of convertible debt that they issued in February. Now, if we look right here, I want you to be mindful of the fact that the terminal multiple is 3x, whereas the current revenue multiple is 11x. That's because if we look at aerospace and defense companies, larger ones in that sector, they trade at like 2 to 3 times revenues. So Rocket Lab's at 11 times right now. What I'm saying is in the next 5 years, they're going to mature and grow into a more stable and sustainable company. Therefore, I'm putting them at the high end of their comps, 3 times terminal revenue. All right, next DCF valuation. So we ran 3 scenarios, bear, base, and bull with the current model at base. Future cash flows are discounted back to today to get to TEV. We strip out net debt to get to equity value. Obviously, Rocket Lab is a leading player in the orbital space launch area, and they're a major competitor to SpaceX. But after doubling in the last 5 months, is it worth buying today? They were $3.50 in mid-April, and they're over $7 today. Now, Wall Street has Rocket Lab at a median of $7, which is fair value, but a high of $10, which is a 39% discount. So what does our analysis show? Let's hop in the model. All right, Rocket Lab DCF, it's pretty much a bloodbath. So we've got negative EBITDA, negative EBIT, negative EBIT. We have the adding back of DNA, the changes in operating working capital, and then CapEx, but we get negative free cash flow to the firm. This is very, very important. The only value from this company is coming from the terminal value, which means the only value that we're getting from this company is from the end of the model out to infinity, that 3 times revenue that we talked about earlier. Without that, this company would definitely be worth a negative value. So we end up having the cash flows to discount. We discount them back to today to get to total enterprise value. We strip out the debt. We add the cash, strip out non-controlling interest, add the associate investments. We get an intrinsic equity value of about $2.0 billion divided by the current shares outstanding. We get an implied share price of about $5.60. Current share price, $7.17. That's a 21.6%, almost 22% premium, which is a sell rating for the stock. All right, sensitivity and scenario analysis. We ran 50 different models by utilizing data tables. We sensitized revenue growth versus CapEx intensity and WACC versus terminal multiple. Now, 41 out of 50 or 82% showed a sell rating, 4 out of 50 or 8% showed a hold rating, 5 out of 50 or 10% showed a buy rating. We ran each of the 3 scenarios equally weighted. We got a weighted average value of $5.80, which is a 21% premium based on what it's currently trading at. So what's the takeaway? Utilizing conservative assumptions, we show a sell rating for the stock in the bear and base cases and a hold in the bull case. Let's hop in the model. All right, so unfortunately for Rocket Lab here, we've got kind of a bloodbath. But again, this is a super high growth company. It generates negative cash flow, so this shouldn't be surprising. There is a silver lining here, though. If we look in this area, 3.5 to 4 times terminal multiple area with lower WACCs, we end up getting about a $9 or $10 value for the stock. So there is some hope, there is some promise here. All right, last but not least, we come to the scenario analysis where we ran our 3 cases equally weighted. We get about 330 in the bear case, 560 in the base case, which is our current case, and 850 in the bull case. We do a weighted average, we get 580. This is a 19.1% premium, which is a sell rating for the stock. All right, the wrap up. Wall Street has Rocket Lab at a high of $10, which is a 39% discount, a median of $7, which is basically fair value, and a low of $4.50, which means it's at a 63% premium. The stock is currently trading at $7.17. It's up 35% year to date, and it's doubled in the last 5 months. Also, it hit a 52-week high of $7.53 only a few days ago. Now, you should seek the advice of an investment professional always. I don't know your individual financial situation. This content is meant to educate, and it's not investment advice. Now, full disclosure, I personally do not have a position in Rocket Lab. So to believe in Rocket Lab is to believe in commercial spaceflight. So let's step back a second here. If you could go to space, how often would you go? Daily, weekly, monthly, annually, once or twice in your life? What are the uses of commercial spaceflight for the average person? Place to send all of your exes? Kidding. Seriously though, unless and until we colonize the moon or Mars, commercial space travel is like plane flights. Commercial space travel, unlike plane flights, has very limited utility. We need to look no further than the electric vehicle space, which is way closer to mainstream adoption. I'm going to throw out some names for you guys. Fisker, Lordstown, Proterra, Electric Last Mile, Arrival, Nikola, all gone. Now, if you want an example from the space area, look at Virgin Galactic, the ticker's SPCE. In 2020, it had a market cap of $5.6 billion. In 2024, today, it has about $200 million market cap. That's a 96% decline. Its stock in 2020, 1,100 per share. Today, it's 7, a 99% decline. Now, unlike Richard Branson with Virgin Galactic and Elon Musk with SpaceX, Sir Peter Beck of Rocket Lab is not a billionaire who can keep the company afloat with his own capital. Frankly, all of his net worth is in the stock of the company, so he's not going to be able to pony up cash to keep the company afloat. Now, if you insist on investing, I would begin with a small position and build it over time as the company shows some positive financial results. Be prepared for a bumpy ride, a lot of volatility in the stock, and dilution from further financing the company with equity and convertible debt. Rocket Lab is a fascinating company in a super niche space that is cutting edge, but it has to survive financially to make it to mainstream adoption, which is easily a decade or longer away. All that being said, I'm going to keep my eye on Rocket Lab. Now, if you like this and want to see some more promising stock valuations, check out my NVIDIA model here or my Palantir model here. And if you found this valuable, please share this with someone who you think would enjoy this. As always, be relentless.